Hello, and welcome back to another lecture series or video series, actually, of demo problems. So we just covered or finished Chapter 11 on Tuesday. We talked about accounting for uh, liabilities as well as payroll accounting. So what I'm going to do here is go through the corresponding B problems. Now, I wrote these down, so we're going to get them right. So for your homework, you have to do problems. Problem 11-1A, problem 11-3A, and problem 11-4A. So that's 1, 3, and 4. What I'm going to do is work through, obviously, the B problems. So we'll review how to set up your Excel spreadsheet, go through each of the journal entries, um, and basically show you how to put together the problem. The idea behind this is that A, it'll give you more exposure to the concepts. B, help you out with your homework because the problems are pretty much identical. Really, the only difference is the numbers. Okay, so what you see here on the screen is problem 11-1B. You got to do 11-1A. So I'm going to run through this one. If you notice here, they give us the liability accounts as of January 1st, 2017. So we can see that right off the bat, we have accounts payable of $35,000, sales tax payable of $5,000, and unearned service revenue of $12,000. Okay, so remember, please do not get confused when you see unearned service revenue. That is not a revenue account, that is a liability account. Basically, what had happened was somebody had given us money to perform a service. We have not performed that service yet. So it's a liability. We owe the customer something. In this case, it's a service. So they list what they got here, like 6 transactions, and we have to go through and notate, or I'm sorry, do the journal entries for the transactions in January. We have to do any adjusting entries. If we have any outstanding notes payable, we need to estimate warranty liability, assuming warranty costs are expected to equal 5% of sales of the new product. And then we need to prepare the current liability section of the accounts that we have. So I'm going to go ahead and pull up Excel. And again, it's a blank document, the Excel. We're going to set it up like we should for a journal entry or for to do journal entries. So basically, we're just going to create a journal here, right? A1 should be the date. I'm going to come over, again, arbitrary amount of cells. I came over 4 cells. I'm going to click my merge and center button. I want to left align, and then I'm going to format the rest of the cells below that B1 cell. Again, get my little crosshairs, that little black crosshair. My mouse is on the bottom right of the cell. If I just click down and drag, it's going to format all these cells below. I'm just coming down an arbitrary amount of lines. Just want to make sure we have enough room to put in all our journal entries. And then in this cell reference B1, we're going to type in account. F1 is going to be our debit column, so we're going to type in BR. G1 is going to be our credit column, so we're going to type CR. Again, in case you guys haven't noticed from my last video, love spreadsheets, want to make sure they look nice and neat. So I'm going to go ahead and center, click the center text button on my F1 and G1. It just centers those debits and credits, makes it look just a little nicer. Remember, we need to put the proper number style in. So remember, we want to go ahead and click our comma button, and then we want to decrease the decimal point by 2 because we don't need any cents here. Okay, so bear with me. I'm going to try and flip back and forth we go. Okay, so January 1, borrowed 30 grand in cash from Platterville Bank on a 4-month, 6%, $3,000 note. So basically what we did was we went to the bank, said, hey, give us 30 grand, we'll sign a note, we'll pay you back in 4 months, and we'll pay you interest. So we need to journal this. Super duper easy to do. I'm going to go ahead and pull up Excel. And the date is January 1. And the first thing we are getting is cash, right? Cash and notes receivable are going to be the first two accounts that are going to be hit in this example, okay? So cash is going up. How do I increase cash? With a debit. So I'm going to debit cash for $30,000. And I'm going to credit notes payable. Now, when we're doing our journal entries, debits always go first, credits always go second. Always indent your credit. This is proper form, okay? So I click my increase indent button once. I'm going to come down here and type in notes payable. Now, it is possible in a real company that you will have more than one notes payable outstanding. That happens. That's okay. What we can do is we can just hit our notes payable and we could notate it, right? We could notate the account that this is actually Platteville Bank. So I'm just going to type in notes payable dash Platteville, okay? What this does is allows us to keep track of which notes belong to which bank, right? So we signed a note for $30,000. We're done. Now, we did the journal entry. Remember, we have to put in our explanation. What do we do? Well, I'm going to make sure the explanation is italicized, and I'm just going to say signed 4-month 6% note. Okay, all the information's here. I signed it out on January, or I signed the note on January 1st, so I can look at this and say, okay, well, January, February, March, April 1st, probably have to pay that note back. So we have all the information here and we're good to go. Okay? Please, 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 please always skip a space between your journal entries. A, it's proper form. B, it makes it look nice and neat. But in my mind, more importantly, makes it easier for me to grade and to see. So the next journal entry we have happened on January 5th. And it says we sold merchandise for cash totaling $11,130, which includes 6% sales tax. So we have a sale here, okay? We sold a bunch of merchandise. We collected sales tax on this, okay? So if you remember in class, we went over these two examples, and I remember Miranda said, well, there's no difference between those two. And there was a very subtle difference in, do we have sales and then tax, or do we get the total amount? And that total amount includes sales and tax. That's this example right here. We have a total amount. We need to figure out, of this $11,130, how much of it is actually sales merchandise and how much of that is actually sales tax that we collected, okay? So the problem, sold merchandise, okay, for cash. So obviously we're getting cash. Cash is an asset. I increase an asset with a debit. I'm going to debit cash, okay? I don't know exactly how much yet, right? I can't put the total $11,130 here. Or actually, yes, I can. I apologize. Right? That's the total cash I received, okay? Now, some of this is going to be for sales revenue. And bear with me here. Sold merch. Yep, sales revenue, okay? And then some of this is going to be sales tax payable. Okay, so I need to figure out how much is sales, how much is actually revenue. Super easy for me to do, right? So check this out. I know that 6% of this dollar amount is going to be equal to sales tax. The remainder is going to be my sales revenue. So what I'm going to do is here, what I'm going to do in here in this cell, I'm going to say equals my total cash amount, which is 11,130, and then I'm going to divide that by 106%. That gives me $10,500. That means that my sales were $10,500. Okay. Now you don't have to do this, but in here, I'm going to go ahead and say, all right, how did I calculate that sales revenue? Well, I took my cash, which was 11,130, and then I divided that by 106%. Okay? So now I need to figure out how, there we go. Okay. Now, I need to figure out how much of this is actually sales tax that I owe. Well, that's easy. Take my cash, total cash that I received, subtract out the sales revenue. $630 has to be my sales tax payable. Okay? Here we can go ahead and put in our explanation. Well, collected sales tax on sale of merchandise. Okay, it's exactly what we did, right? Remember, skip your space, please. Okay, next journal entry we have is January 12th. Okay, so on January 12th, it says performed services for customers who had made advanced payment of $8,000. Look at that. They even give us a hint. Credit service revenue. Okay. Well, previously someone gave us $8,000. We said, okay, thank you. We will perform these services for you later. Customer was okay with that. January 12th rolls around. We actually perform those services. We do not have a liability anymore. Why? Because we earned that sales revenue, right? We went from receiving cash, owing somebody a service, that's the unearned service revenue. Later on down the line, we actually provide that service. We have earned service revenue. So what I'm going to do here is I'm going to debit my unearned service revenue for $8,000. Of course, I'm going to debit it because it's a liability. My liabilities are decreasing. How do I decrease a liability? I hope in your head you said you got to debit it. Okay. Next thing, we need to show that we have in fact earned sales revenue. The hint, if you will, in the problem says credit service revenue. So that's what we're going to do, right? Make sure I indent. Type in, usually helps if you could spell. Type in, type in service revenue for $8,000. What is my explanation here? Well, performed services that were already paid for or previously paid for, whatever. Okay? Please skip a space between your journal entries. Okay, the next one is January 14th. So check this out. Paid State Treasurer's Department for sales tax collected in December of 2016, $5,000. Now, I'm not sure exactly how Ohio is um, or the state that you live in, but in Pennsylvania, sales tax always has to, well, depends how much you have in sales tax. Excuse me, but sales tax usually needs to be paid on a monthly basis, and we pay the prior month. Okay, so we are January 14th. We need to write a check to the state treasurer's department for the taxes or the sales tax that we collected on the sales that we made in December. Okay, so here's the journal entry. Super easy. January 14th. What are we doing? Well, we already have established sales tax payable $5,000, right? This was as of January 1st. On January 14th, we're paying that amount. So I need to decrease a payable and I need to decrease my cash because I'm paying cash. I'm sending them a check probably. So, super easy to do. I need to decrease my liability. How do I decrease liabilities? With a debit, right? So, I'm going to debit sales tax payable for the amount of $5,000. I'm going to credit cash. Please indent cash. $5,000. What did I do here? Well, I paid sales tax for December. I need to put that in the explanation for the journal entry. Paid December sales tax. That's it. Okay? Skip space. The next thing we have is January 20th. We sold 750 units of a new product on credit at $44 per unit, plus 6% sales tax. Okay? We can do this. Super easy. I know we got a lot going on here, but let's think about what we did. We sold something on credit and we collected sales tax. Okay, no problem. We can do that. We can do that super easy, right? So, on January 20th, what are we receiving, right? Let's think about it that way. Well, we're receiving an accounts receivable, right? We have a receivable. We sold units on credit. In other words, we gave somebody 750 units that cost $44 per unit. They said, hey, I can't pay you now. I'll pay you next month. We say, no problem, right? We have an accounts receivable. So what do I do here? I'm going to debit accounts receivable for how much? Well, let's think about this. Okay, I'm going to come over here and just do my calculation. We sold 750 units. They cost us 44, or the sales price was $44 per unit. So I have $33,000 worth of sales. Okay, I collected tax on this. I collected 6% of tax. So if I take my total sales and I multiply that by my sales tax, and I'm just going to say 0.06 because that's 6%. I get $1,980. Okay, that's my tax payable. Okay. All right. So how much cash did I get for this? Well, or how much cash is owed to me? Well, the $33,000 in sales revenue plus the sales tax. Okay. So I have my accounts receivable. I am owed $33,000 in sales revenue plus $1,980 in sales tax. Okay, so I'm going to credit sales revenue for $33,000. I'm going to credit sales tax payable. This is a credit, so I need to indent. Sales tax payable, 1980. And that's the journal entry, okay? Again, I need to go ahead and put my explanation. What happened? Well, sold merch on account. Collected 6% sales tax, okay? Tells me everything we need. All right, so now we have the warranty that we need to do, okay? So we need to list the warranty. The new product is subject to a 1-year warranty. Okay, great. Do we have enough information to notate what exactly the warrant is? No, we don't, right? We just have this new product is subject to a 1-year warranty. Okay, that's great, but at what percent, right? If you remember in class, we worked on problems in the company assumed that X amount of sales, like a certain percentage of sales, would claim that warranty, right? We don't have that here. We don't have really enough information, okay? I know it says it down here, but just work with me, okay? Okay, the 25th, the last one. So January 25th, what do we do? January 25th, we sold merch for cash totaling $16,536. This total cash that we received from selling merchandise includes sales tax. No problem. You already know how to do that, right? So, how did we sell the merchandise? Well, we sold it for cash, so our cash is going to go up. We have sales revenue, and we have a sales tax payable that we need to hit, okay? So the first thing I'm going to do is debit my cash. For how much? Well, the total cash that we received, $16,536, okay? The next thing I'm going to do is I'm going to indent, and I'm going to credit sales revenue. Now, I need to figure out exactly how much that is. Well, I know that the total cash I received was $16,635. I can divide that. I can divide that by 106%. I get $15,693. That is the amount of my sales. Now I got to figure out what is my sales tax payable. Sales tax payable is a liability. I credit it. I increase a liability with a credit. So I need to indent my credit. Type in sales tax payable. And I'm just going to subtract. Total cash I received minus my sales revenue. That gives me my sales tax payable, okay? So we already did part A. We journaled everything, right? Now what we need to do is we need to do our adjusting entries, okay? So let's think about that. Well, what do we need to adjust for? We need to adjust for interest for the month, and we need to adjust for that warranty expense, right? They tell us here that the estimated warranty liability, assuming warranty costs are expected to equal 5% of sales of this new product. We have enough information to do our adjusting journal entry to recognize the warranty expense, okay? Super easy to do. So let's go back I'm going to come down here, skip space, and I'm going to say 131 because this is an adjusting entry. First thing I need to do, or first thing I'm going to do, excuse me, is recognize my interest expense and my interest payable from the note that I signed on January 1st. Okay, so see why we put this explanation here? 4-month note, 6%, or 4 month 6% note, right? That 6% is going to be based on a year. Excuse me, okay? So I'm going to come down a little bit, and I'm going to go ahead and do my adjusting entry. Well, I have interest expense, and I'm going to credit interest payable. Okay, I just need to figure out that dollar amount. Well, that's easy for me to do because I know I took out, and I'm going to put it down here in my explanation, right? $30,000 times 6% times 1/12. Of course it's 1/12. Why is it 1/12? Well, that amount that they gave me, that 6%, is for the year. I need to accrue interest for 1 month. That's the calculation. So to make it even easier, I'm going to plug this into Excel. 30,000 times 0.06 times 1/12 gives me 150 bucks. And that's the amount of the debit and the credit for the interest expense that we accrued, okay? The next journal entry we need to do is to recognize that warrant expense. Super easy to do, right? Warrant expense is going to be debited, and I'm going to credit my warranty liability expense. Sorry. There we go. Liability expense. Or, I'm sorry, warranty liability. That's it. Okay? So, we need to figure out how much that is. Well, that's easy because they gave us more information. We know that when we sold this, and let's go back and look at it. We know that on the 20th, we sold 750 units at 44 bucks a pop. This is the journal entry we did to recognize that sale. Okay? So the sales revenue is $33,000. So I'm going to come down here and I'm going to say 33,000 times that expected warranty cost, which is 5% of the sales. Okay, 33,000 times 5%. And why am I doing this? To recognize warranty expense. Okay, so just multiply out the numbers. 33,000 times 0.05 gives me $1,650. Okay, that's how you book a warranty expense. Now, we have to do part C. Prepare the current liability section of the balance sheet at January 31st, 2017. Assume no charge in accounts payable. Okay, so that's easy. So accounts payable looks like it did not change, right? There was no change in there. So to list my liabilities, right? I'm just going to come down here and do it. I'm just going to say, this is part C. This was part B. And This was part A. Okay. Okay, so now what I need to do is list out, well, I have accounts payable. And remember, since we're listing out the balance sheet, debits and credits really don't apply here, okay? All we're doing, what I'm doing here for Part C does not go on the journal, okay? I'm just putting it under here just to kind of make it easier. Put everything on one page, but you don't need to do debits and credits, okay? You could just put it right next to the name accounts payable. And the problem told us that we had $35,000 in accounts payable, okay? So now, what else do we have, right? We know there's sales tax payable and that we know there's unearned service revenue, okay? So let's think about this. Let's think about our sales tax payable. Now, we could do one of two things. We could do a T account, which would be so much easier. Or we can just look at our journal entries that we did and find out if there's anything that affects sales tax payable. Okay, so what I'm going to do is I'm just going to go ahead and create the T account. Reason why, we all know it's sexy. We love T accounts. And it makes it easier for us to determine the value of the account. So we have sales tax payable, and we started off with a credit of $5,000. Okay, that's the beginning balance we had as of 1/1/2017. So now what I'm going to do is I'm going to go through my journal entries and I'm going to say, okay, did I hit sales tax? Yep, sales tax payable. Yep, second journal entry on January 5th. I have a credit for $630. So I'm going to plug that in. Okay, let me go back through and look. January 12th did not hit sales tax. January 14th. I hit sales tax payable. I decreased it by $5,000. Oh, sorry. So I'm going to come down here and I'm going to hit my debit or post my debit of $5,000. Okay. And then I need to look, did I hit sales tax payable any other time after I paid it? Yeah, I have some right here, right? On January 20th, we collected $1,980. Sorry. So I'm going to post that credit, $1,980. And then I need to look and see if I hit that sales tax payable any other time. Yep, sure did. January 25th, sales tax payable, debit of $942. I'm going to post that. Okay. Did I hit sales tax payable any other time? Nope, I didn't, because after January 25th, I did my adjusting entries. Sales tax payable was not hit. Okay. So I started off with $5,000. I added $6,300, subtracted out $5,000, and then I added $1,980 and $942. So if I just add these three up, I can do that, and I see that I get $3,552. Okay, so that's one. So that's the second accounts payable or liability we have. The next one is unearned service revenue. Well, plug it in. Okay, so let's go through our journal entries and say, what would we need to post to the ledger from our journal that affects unearned revenue, okay? And I'm going to do another T account. Bear with me here. Okay, so we now have unearned service revenue. Just going to abbreviate, okay? We started off with $12,000. It needs to be a credit. Why? Because unearned revenue is a liability. We increase it with the liability, or I'm sorry, unearned service revenue is a liability. We increase liabilities with a credit, decrease liabilities with a debit. Credit's a normal balance side, okay? So I want to go through here all my journal entries and see, did I hit unearned revenue at all? Yep, sure did. I didn't on the first journal entry. That was taken out a note. The second journal entry, just book sales, received cash for it, no unearned revenue. When I get down to January 12th, yep, I have a debit of $8,000 to unearned service revenue. I'm going to plug that in. To figure out what my balance is, all I'm going to do is subtract. I'm going to take $12,000 minus my $8,000, gives me $4,000. That is my new balance as of January 31st for unearned sales revenue. Okay. So we got all our liabilities, right? Now we need to go back through and look. Is there any liability that we missed? And I can tell you right now, I know there is. It's that warranty liability. We need to plug that in. So I'm going to say warranty liability. There we go. For $1,650. I'm going to add all these up. And I see that my current liabilities is $44,202. The problem tells me that they give me a check figure. Current liability total should be $74,346. So we're off somewhere, right? Where are we off at? Well, let's make sure we added up we had to add up the sales tax payable. Yeah, 3,552, okay. The unearned revenue, we did book correctly to be $4,000. The warranty expense, make sure my math's right on that one. Yeah, that's right. Looks like I hit everything. Why is this not adding up? Huh. So we're off what? Yeah, we're off a little bit. I'm confident we did that right, unless I missed something. But I'm confident that this might be a misprint in the book, which does happen. Oh, nope, I know exactly what we forgot. Duh. Notes payable. That was the first journal entry we did, right? Notes payable, $30,000. There we go. So we're a little closer. We're a little closer, 74,202, 74,346. So chances are I probably messed something up in one of my calculations. I'm okay with that for right now. Probably was my What's the number here? Bear with me here. 1980, 942. Oh, duh. Interest payable. $74,352, $74,346. So I'm a little over. Again, probably had something to do with one of the numbers that I calculated up here. I'm okay that it's off slightly. The point is, the real takeaway here is, number one, making sure you know how to correctly do the journal entries. Number two, making sure you know how to put together the total liability section, and basically just booking that sales tax, excuse me, booking those warranty expenses, okay? When we come back in our second problem, we're going to look at problem 11-3, and that deals with payroll, okay? So please tune back in for that one.